Have you ever looked at a bond or really any financial instrument and just wondered, what's it really worth? Well, today we're basically going to become financial detectives. Together, we are going to crack the code on one specific bond, and we're going to figure out not just its price, but also the hidden risk that's lurking inside.
So yeah, these are the big questions we're going to tackle. A bond is really just a promise to pay you money in the future. But how do you figure out what that promise is worth today? And maybe even more importantly, how do you measure the risk that comes along for the ride? Let's solve this thing.
Okay, here's our roadmap. We'll start with a puzzle, then we'll gather our clues, we'll do the math to get the price, measure the risk, and then the big reveal. Let's get into it.
All right, let's open up the case file. The bond we're investigating is a 6-year bond, and it was issued way back on February 25th, 2011. Now, our specific mission is to figure out its true fair value on one particular day, June 26, 2014. Every good investigation starts by getting the facts straight. So before we can even think about touching a calculator, we have to collect all the critical pieces of the puzzle. These are the clues that are going to lead us to the answer. First clue on the board, the coupon rate. This bond promises to pay 5.4% interest every year on whatever principal is still outstanding. This is our starting point for figuring out the actual cash payments that an investor is going to see. Clue number 2, can't forget about taxes. A 25% tax rate gets slapped on all of those interest payments, and this is a super important detail because what we really care about is the cash that actually lands in your pocket, not the number before the taxman takes his cut. And here's a really big one, the market yield. This is the after-tax return that investors out in the market are demanding right now for bonds that are just like ours. This 7.2%, this is our magic number. It's going to be our discount rate, the tool we use to bring all future money back to its value today. And finally, let's get our timeline straight. Think of it like a map. Issued in 2011, matures in 2017. But the most important date for us is right here, the You Are Here marker, our valuation date of June 26, 2014. Everything we do is from the perspective of this single day looking forward. All right, we've got our clues, we've got our map. Now for the fun part. Let's start following the money trail and actually calculate this bond's true price. This is where the investigation really gets good.
Now, don't worry, we've got a super clear 4-step process for this. First, we'll map out every single future payment. Second, we'll figure out exactly when each payment arrives. Third, we'll use our discount rate to pull all those future payments back to today. And fourth, we just add it all up. Simple as that. So here it is, step 1, a complete map of all the money we're expecting. Now look closely at that interest net column. See how the payments start at 0.76, but then bam, they drop after that principal payment in 2015? That's because the interest is being calculated on a smaller and smaller amount of principal. It's a key detail. These cash flows are not all the same. Okay, on to step 2, timing. And this is so important because of the time value of money, right? $1 today is worth way more than $1 tomorrow. So when you get the cash matters a lot. We calculate the exact time in years from our valuation date to every single one of those future payments. So how do we actually account for that timing? Well, we use what I like to call the financial time machine formula. It's awesome. It lets us take any amount of money from the future and see exactly what it's worth in today's dollars. All we do is divide the future cash flow by 1 plus our yield, raised to the power of time. And here is where it all comes together. We take our time machine formula and we apply it to every single cash flow. So that final payment of $25.25, which we get in over 2.5 years, it's really only worth about $20.97 today. We do that for every payment. And then, the moment of truth, we sum up all those present values. And there it is. The fair price for our bond is $71.82. So we found the price, $71.82. Case closed, right? Well, not so fast. A really good investigator knows the price is only half the story. Now we've got to dig a little deeper and understand the risk that's hiding just beneath the surface. So here's the next big question. What happens to our bond's price if that market yield, that 7.2%, suddenly goes up or down? This, my friends, is called interest rate risk. And it's probably one of the most important risks any bond investor needs to get their head around. To measure this risk, we need a special tool. It's called Macaulay Duration.
Now, I know it sounds a little intimidating, but just think of it like this. It's one single number that tells you exactly how sensitive your bond's price is to changes in interest rates. It's a risk ruler, basically.
And the calculation is actually way easier than it sounds. We just take two columns we already have, the present value and the time, and we multiply them together for each row. This gives more weight to the cash flows that are further out in the future. Then, you guessed it, we just add up that new column.
And believe it or not, this is the final step. We take that big number we just calculated, the 113.83, and we simply divide it by the bond's price we found earlier, the 71.82. And the result? 1.58 years. That number, 1.58, is our bond's Macaulay duration. Okay, the math is done, the clues have all been analyzed, our investigation is officially complete. It's time to deliver the final verdict on this 6-year bond. So, after all of that, here's what we found. Two key numbers. The fair price to pay for this bond on our specific valuation date is 71.82, and its risk, measured by duration, is 1.58 years. These two numbers tell us pretty much the whole story.
So, what does this actually mean for an investor? Well, it's pretty straightforward. 71.82 is what you should pay. But that duration of 1.58 tells you exactly what to expect next. If market interest rates go up by 1%, you can expect this bond's price to drop by about 1.58%. And if rates fall by 1%, the price should go up by 1.58%. That is the practical power of knowing a bond's duration.
And with that, our investigation is closed. We've cracked the code, found the fair price, and uncovered the hidden risk. So now, the final question isn't for me to answer, it's for you. Knowing its true value and its sensitivity to change, would you buy this bond?